this week's edition of On the Money with Secure Money. I'm Rebecca Powers, and of course, this is Brian Quaranta of Secure Money Advisors. Great to see you, Brian.
Always good seeing you. How you been?
Doing great.
Good.
And I always love your energy, your information, your positive outlook. You're always kind of the lighthouse when people are looking at things like the stock market.
Yeah.
And they're looking at their portfolios. I know that your clients sleep very well at night because you do secure money.
Yeah. Well, you know, that's because I got started in the business in one of the worst decades ever. And that was like right after the tech bubble had bursted in '99. And I saw a lot of people lose a lot of money. And that changed my life. I can remember I had just graduated from college. And I thought I was going to go back home to New Jersey to work on Wall Street. And I had a friend of mine say, hey, why don't you come interview with this big firm in Pittsburgh? So I went down, I interviewed, I passed my exam. I was excited to become the best financial advisor you could possibly imagine. I was going to do anything, right? I would learn as much as I could. And I get an opportunity to work for this big firm, and I'm being mentored by advisors that have been in the business for 25, 30 years, sitting in meeting after meeting with them, listening to what they're saying, how they're calculating, how they're positioning people's money. And at that point in time, I was considered what you would call a go-getter, right? That was like, hey, kid, can you go get me a cup of coffee? Hey, kid, can you make copies of this stuff? And I was really willing to do anything. And they put me on the phones one day to answer the phones. And of course, the market was dropping like crazy. And you can imagine the phones are ringing. And who do they have answering the phones is the new guy, right?
So they don't want to take the
They don't want to take the calls. They're all hiding under their desk. So I take a call from a guy that's very upset. And he says, I want out of the market right now. And I don't know what to tell the guy, right? So I said, well, who's your advisor? What's his name? So I go to the advisor's office and I say, look, you got a client online. He's very upset. He wants to get out of the market today. Are you okay if I place the trades and liquidate and get him out of the market? And that advisor looked at me and said, Brian, I want to make something very clear to you. We do not sell when portfolios are down. I need you to get back on the phone with this individual, and I need you to let him know that everything's going to be just fine. And that all he's experiencing right now is a paper loss. Now, for those of you out there that are experiencing losses or have experienced a loss, does it ever feel like a paper loss to you? And for most people, they'll say, no, it does not feel like a paper loss.
Absolutely not.
But then he gave me the magical phrase that you'll hear all the time from every advisory firm. He said, Brian, let that individual know not to worry about anything, just to hang in there, that he's in it for the long haul. So guess what I do?
What?
As a good employee, I go back and I repeat that verbatim to this individual. And this guy changed my life, because I went back and I said, I want you to know everything's gonna be fine. It's just a paper loss. Hang in there, you're in it for the long haul. And he said, Brian, I'm 65 years old. How much damn long haul do you think I've got left? And his health wasn't good. And it really made me start thinking about what I was doing in financial planning. Because you know what I learned? It's really easy to risk somebody else's money, especially if you get paid a fee or commission to do it.
That's right.
So when I started Secure Money Advisors, it was out of frustration that it wasn't because people people weren't ruining their retirements because they were losing money. They were just losing money at the wrong time when they couldn't afford to lose money, because they don't have time to recover. And this is why I built Secure Money Advisors. It's why I wrote my book, Right Track Your Retirement, because I want people to have the information that there was an old way of doing it, but now there's a new way, and we want to teach these strategies of how to do it.
Now, that firm you were with, I'm sure, was one of those big boxes. We call it the big box retailer. Their names on the stadiums and the U.S. Open and all this. They have this massive overhead. But you learned a very important lesson that day, because you have deep, deep ethics.
Yes, yeah.
And you knew that that was not the right thing. But this, even though it's not the right way anymore, it never has been, it's still happening. Don't you believe that? People are still unaware.
Yeah, well, think about it. I mean, we were once allowed to eat carbs, and we weren't supposed to eat fats, and now we're supposed to eat fats and not carbs.
Make up your mind.
So, and it's the same thing with financial planning.
Yeah.
What we're realizing, though, and you got to remember, we're talking about a long period of time that Wall Street has controlled retirement accounts, right? You go back to, the late 70s when they created the 401k account. You look at how much money went in the stock market when the 401k account was created. It went up like a hockey stick of how much. And because they started controlling the message, people started getting away from things that they need in retirement, like a pension.
Yes.
Right? Think about how easy retirement planning was when you had a pension, because you knew exactly the date you could retire. You were having probably a retirement party. You don't see those anymore.
That's right.
My grandma and grandpa went to retirement parties all the time.
I remember that.
You know, I don't talk to people at all because they don't know if they can retire, because the main problem right now in our country is that 85% of the people retiring, if not more, are not retiring with a pension. They're retiring with a 401k.
Right.
Now, a 401k is an accumulation tool.
So it did its job, but now you need to make it your personal pension.
And I write about this in the book, which, by the way, if you go to righttrackyourretirement.com, you can get a copy of my book. You can also schedule a complimentary Right Track review there. But in my book, I talk about the new strategies you want to start considering, because you have to think about creating your own private pension, essentially, before you do any type of risk investing.
Very first thing you need to do.
Very first thing.
And retirement planning versus investment planning. I wanted to ask you, is it the same thing or what's the difference?
Yeah. Well, it's very, very different.
Okay.
Because investment planning is your 401k, right? And that's when you have time on your side.
Right.
And you can diversify your portfolio amongst different asset classes. And if the stock market goes down and you're 35 years old or 45 years old, you're going to have a long time before you're going to need that money. But when you start to get about 5 years from retirement or even in retirement, now those losses impact you more than you could possibly imagine. And this is why people are running out of money today.
Right.
Right? Because they're losing money at the wrong time, and nobody out there is telling them to protect a portion of their money first. It's not that I don't believe in the stock market.
Sure. You need it for those gains.
And you need it to keep pace with inflation.
Gotcha.
But people are gambling with 100% of their life savings, and it's not the right thing to do. And, you know, again, like I said, I mean, it's easy for somebody else to tell you to take risk with their money, especially if that's their job and they get paid to do it.
And they have quotas.
And they have quotas. But, you know, what I always tell people is get yourself with a good fiduciary firm, because, you know, a fiduciary is held to the highest standard that there is, and that standard is a code of ethics that have to be followed. Not only that, but the fiduciary is required to have a higher level of education, so they're going to understand the planning process in depth a lot more than the majority of your licensed advisors out there. And people need to understand the difference between that. But at Secure Money Advisors, it's really all about making sure that we protect your income first, because the most important thing that you're going to need more than anything going into retirement and through retirement is what I call mailbox money, a check showing up every single month, just like Social Security, so that you can go out there and do the things that you want to do. Think about the way people are building it now. They're literally rolling the dice with 100% of their money, and they're pulling money out of the market, whether the market's up or down. And when you start pulling money out when the market's down, you're compounding those losses, and you're locking into those losses. And this is why the biggest concern in our industry right now is more and more people are potentially running the risk of running out of money.
Absolutely.
So,
and a report recently said that more Americans were scared to run out of money than actual death.
Yeah, that was an AARP study.
Yeah, you saw that. So what does that tell you? That's how scary it is.
Yeah, they interviewed they interviewed 1,000 people, and 90% of them said they fear death more than they fear. I'm sorry, they fear running out of money more than they fear death. Yeah.
You said the word gambling and gambler, so I'm going to look at my notes on chapter 2 of your book. I love this chapter. It says, "Think like a pensioner, not a gambler."
Right.
And that's exactly when you leave 90%, or you don't even know what percent you have in the market, you are gambling, period.
Period. And we've got to understand what risk means in retirement, right? So Wall Street has done a really good job in quantifying risk, like conservative, moderately conservative, aggressive, very aggressive. The bottom line is this, folks. If it can go up in value or down in value, it's risky. We had 20-year treasuries, because of interest rates going up, that were down over 20%. U.S. treasuries. That's down over 20%.
Never happens.
It's a perfect storm. So don't be fooled by the fact that, you know, just because you hear the word bond or fixed income, that you're going to be guaranteed. Right? That's not the way it works. Those still can lose. So we define risk as if it can go up or down in value, it's risky, period, bottom line. You want guarantees? Go buy a CD. That's a real guarantee. Right?
But not much gains.
But not much gains.
But there are other safe tools that you use.
There are other safe tools out there, which I write about in the book. And again, if you go to righttrackyourretirement.com, you can get a copy of my book there. And you can also schedule a complimentary Right Track Retirement Review. And my promise to you is this. When you come in, no one will sell you anything. No one will pressure you to do anything. Leave your checkbook at home. My promise is that the meeting will be informative and very eye-opening. As a matter of fact, you can call 888-382-1298 and schedule. Again, that's 1-888-382-1298 to schedule. Or you can go to righttrackyourretirement.com also to schedule there. Or you can scan the QR code. We're giving you a ton of ways to schedule.
Exactly. We're going to take a very short break. As Brian said, there's the number 888-382-1298. No obligation at all. Stay with us. More right after this.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people will also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No, 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 no. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
Welcome back to On the Money with Secure Money with Brian Quaranta, and I'm Rebecca Powers. We were talking about risk. It's not just a cookie cutter word, conservative or not. It is actually something that can completely deplete your hard-earned savings. Risk analysis is one of the wonderful things that you're offering as well.
Yep.
And talk about how it's a third-party report. It is not biased in any way, and it's very eye-opening.
Well, again, this goes back to why I think it's so important that people work with a fiduciary firm.
Amen.
Whether it's Secure Money Advisors or somebody else, just go find a fiduciary firm.
And ask that first. Are you a fiduciary?
Are you a fiduciary? Because, again, fiduciaries are held at a highest standard, but they're also required to have a higher level of education to understand the planning process, to provide you with a real plan, and only make moves that are in your best interest.
Exactly.
Because if moves are made outside of your best interest, the regulatory environment could take action, right? So that protects the individual consumer. But in regards to risk is something that we can quantify now differently than this conservative, moderately conservative, aggressive, very aggressive stuff. But we use a very powerful software called Riskalyze that's backed by also something called Morningstar. And what's nice is we can input the individual's current retirement plan, right? All their individual investments into this software. And then we can build a plan, and then we can look at the difference. And now you're not getting an opinion. You're literally getting just a black and white report that just shows you the data of where you are and what changes could be made, if any, to improve your situation. And I always say, look, when people come into our office for a review or an analysis, whatever, we call it these days, they're there to get that analysis, and that's it.
Yeah.
I mean, at the end of the day, my team knows that we're problem solvers. And if there's a problem to be solved, we can show the problem. And if they want to solve it, great. But the great thing for a lot of people is if they come in and they are in a good position,
you'll tell them.
You'll tell them.
Yeah.
Keep doing what you're doing. If anything changes, call us.
Right.
So, but risk is a very important thing to quantify and understand it, because when you run these reports, they're very eye-opening.
Yes.
Think about the technology is just amazing, because this can be done and quantified numerically now without these opinions, because opinions don't have a place in this. And when you build a strategy around these black and white data points, it becomes very easy to make an informed decision. And that's what I found in my life, is that people are smart. They can make informed decisions. They just need somebody to guide them. That's it. And that's our job, is to guide them.
Yeah. And besides the risk analysis, it also talks about what you're actually paying in fees.
Yes.
That's another eye-opener.
Yes. Yeah, because keep in mind, folks, Fees will reduce your gains and compound your losses. Let me say that again. They will reduce your gains and compound your losses, because fees come out whether you win or lose, right?
It's the same.
Yeah, I mean, people lose money. The advisor or the portfolio manager still takes the fee out, right? So, they win regardless. And again, I mean, we got to be very careful in the level of risk that people are taking, because when you run these reports, the real eye-opening thing is risk versus reward. And a lot of times what these reports will show is they're taking this much risk, but they're only getting this much reward. Well, if I'm taking this much risk, I would like my reward to be a little bit more.
Exactly.
Right? It shouldn't be this much risk and this much reward. So it's got to be flipped. So that's the beauty in doing these risk analysis, because it's very eye-opening for people, and they start to get some clarity around what they currently have. And when you get clarity, you start to have confidence. And when you have confidence, you go into retirement with peace of mind.
Exactly.
It's very simple.
That reminds me of another chapter in your book when you're talking about leveraging the power of the two buckets, because you're thinking, well, how are brokers losing my money, but this guy says he's going to, get me. It's not about that, but it's about moving some of that risky money into safe money.
Well, and it's even more important than that, because what most people have never been taught to do is define the purpose of their money.
Give it a job.
Give it a job. That's right. What is the purpose of the money? And there's really only 4 things that the money can do for you, right? Number 1, it can provide you with income. That could be the main purpose of it. Number 2 is it could be safe, right? Number 3 is it could be risky and be in some type of growth position. Or number 4, it could just be under your mattress and liquid, available for emergencies.
What's your address?
Yeah, right. So we have to first define the purpose of the money. And when we're defining the purpose of the money, now we can figure out how much money do I need to set aside for my pension, because essentially that's what you're doing. You need to create your own pension by setting that money aside. But remember the story I told you at the beginning of the episode here.
Yeah.
The individual has said, I'm 65 years old. How much long haul do you think I got left?
Yeah.
You can be in the market, but the key to being in the market is that any money that's in the market has to be long-term money. And when I say long-term money, I mean that money needs to be in there for 10 years or longer if you want to be successful with your market money. Too many people get caught up in the short-term volatility of the market.
Yeah.
But this is all in my book. This is all in my book. All these chapters are laid out from A to Z so people could read about this, understand it, and when they come in, they're even more informed. And again, folks, if you go to righttrackyourretirement.com, you can get a copy of my book. It's absolutely free. We pay for the shipping and handling, but you can also schedule your complimentary Right Track review right there also.
And righttrackretirement.com. And the number again, 888-382-1298. More on how you can keep your money secure with Brian Quaranta right after this.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
Welcome back. We're talking about safe money and, most importantly, for your retirement, income. So you have to make that income plan. Social Security is just a part of that income plan. It was never meant to be entire salaries.
Right.
So that's kind of one more part. You've got these 5 key areas of retirement. Income is a big part. So let's talk about Social Security.
Yeah. Well, first off, there are ways to maximize Social Security. And if you are looking for ways to maximize, You have to do that today differently than before because you probably are going to need to leverage some of your retirement assets to be able to potentially delay Social Security to get a larger amount from Social Security. But Social Security was only designed to cover about 30 to 40% of your salary. That's about it. So, that's a big income drop.
Sure
and
is.
for most people retiring today, the only guaranteed source of income that they're going to have is Social Security.
Yes.
So where are you going to get that other income from? And this is where we help people figure out through our cash flow planning where are going to be the places to best maximize your income. Because the goal in retirement really is to get your income as high as you can, but as safely as you can. And you want that income coming in every single month, just like your Social Security check's going to come in every single month. And if you're a married couple, if your spouse dies, you want that income to still come in. Because Social Security, if you're a married couple, is going to take at least one check away from you, right? They're going to take the lowest check away.
You told me you can keep the highest check, though.
Keep the highest check, right? But Social Security takes away the lowest check, right? So, but I write about the 5 key areas in the book because, I hear so many people refer to their 401ks or their IRAs as their retirement accounts. And if those accounts are invested in the stock market, those are investment accounts. It's that simple. Retirement accounts do what retirement accounts do. They generate cash flow. That's what they're supposed to do. That's why we had pensions, right? Now, if there are people out there that might be fortunate that they don't have to take any income from their retirement, because there's people out there that still do have pensions, but that's not the norm anymore.
Definitely.
So, but the 5 key areas that I write about, number 1 is income, because without income, you can't retire, right? When you retire, the day you retire, the paycheck's gonna stop, but the bills, the taxes, and all the things that you want to do, all the things, the bucket list that everybody talks about, that you're supposed to go do, that most of you might not be doing because you're too scared to spend your money because you're not sure whether or not it's going to last. Don't live like that. You don't have to do that today. But I talk about income so much because what they found in studies is that people that have the highest levels of income in retirement and guaranteed are the happiest.
Yeah.
Because they're not worried.
Right, they're stress-free.
They're stress-free. But number 2 in the 5 key areas is the proper mix of investments. Having the proper mix of investments. Number 3 is having a good tax strategy. Because there's 2 things that are going to erode people's wealth faster than anything else. And that's inflation and taxation.
Yes.
Right? So we want to make sure that if we can get Uncle Sam out of the picture sooner than later, that's going to be better because people don't realize, look, if you need $1,000 a month from your retirement accounts, and it's coming from a 401k or an IRA, you're gonna have to pay taxes on those withdrawals.
It's kind of like you have a silent partner and he's taking 30%, and you think you got $1, but you only got 70 cents.
That's it. You got it. So you take $1,000 out, you're not getting $1,000. You're only netting, let's say you're in a 20% tax bracket, you're only netting $800.
Yeah.
But you ask most people, you think taxes are going up or down in the future? Most people would say they're going up.
They're definitely going up. And the sunset, the bill currently is sunsetting the end of 2025. So it's really important now because you've got 2 years to take advantage of all of these. And some of the tools that you use in that tax planning, not looking back a year like your CPA does, but looking forward the rest of your life, it can save hundreds of thousands potentially.
Absolutely. Yeah, absolutely. Because when people don't tax plan, they have even bigger problems in the future because the IRS forces you to take money out of your retirement accounts, whether you want to or not. Right now it's at the age of 73, okay, and it's gonna go up over time. It's scaled out. But when you're forced to take these large distributions even later in life, your taxes on your Social Security go up, and your Medicare premium can even go up.
Really?
Yes, because if you make too much, your Medicare premium goes up.
I didn't think of that.
So it's this compounding effect. It almost feels like it was brilliantly designed.
You think? Well, that's why it's such a dance. That's why it's such a serious, perfect thing, because if you, let's say you roll too much, you convert too much into your Roth, but you did it improperly, or they did it improperly, and it puts you to a higher tax bracket. So there's so many kind of landmines.
Yes, yes.
See,
here's the thing. People mistake retirement planning with like trading stocks.
Definitely.
They think that, right?
Yeah, because we were never taught any of this.
I employ the traders, okay? They don't know how to engineer anything. Okay, they know how to create the material, but they don't know how to build the bridge.
Right.
So they need the fiduciary advisor. They don't. We employ the traders. They don't know how to build the bridge. And to your point, there's a lot of moving parts, and if you don't have somebody overseeing that project, you're going to get yourself into trouble. And
or if you're a cookie cutter situation like the first firm you were with, like so many are, you really are an A, B, C, D, or E and not that individual person. That's imperative too.
It's imperative. It's imperative. So the last two key areas are is a healthcare strategy.
Yeah.
Where people are exposed the most is if a health event were to occur.
Sure.
And I had a really good friend, 58 years old, mentor of mine in this financial business, and very successful. And very good friends with him. And I got a call, in 2022, Thanksgiving morning, that he had a stroke. And that came out of the blue. No one would ever thought he was a healthy guy.
Yeah.
And you just never know when a health event is going to strike.
That's right.
And for most people today, they're exposed if a health event takes place. Right? I mean, you look at the average cost of nursing home right now in Western Pennsylvania is about $14,000 a month. $14,000 a month.
No one could afford that.
You could have a $2 million portfolio and it's going to kill you, right? So people need to get serious about this stuff and understand that, look, we've got very, very smart people out there designing things to help us solve these problems. But Wall Street convinces us that they still want us putting money in things like mutual funds and individual stocks and ETFs, which are all fine. But if you don't take care of these other things first, none of that stuff's going to matter. I don't care if your advisor earned you 20% a year. If you're not protected from a health event that could cost you $14,000 a month, it doesn't matter how much money you earned over the years.
Absolutely.
And we see it happen. Unfortunately, people contact our office when they're in a crisis mode sometimes, and unfortunately, there's nothing you can do at that point. And the last part is the estate planning part. But again, this is all in the book, right? So go to righttrackyourretirement.com. You can get a copy of my book there. It's absolutely free. I ship it to you absolutely free. But it's also a place where you can schedule a Right Track Retirement review and get this review. And my promise to you is this. If you go there and schedule that meeting, no one is going to sell you anything. No one's going to press you to do anything. We're going to give you an analysis, very black and white analysis, and it's going to be very eye-opening and very informative. So schedule today. We look forward to seeing you there, or call 1-888-382-1298. Again, that's 1-888-382-1298. Or you can even scan that QR code down at the bottom for those of you that are tech savvy. So I guess we'll see them again next week sometime.
Yes, this show flies by. Thank you so much, Brian. And thank you at home for joining us. We'll see you again next time. Keep those calls and emails coming in. We love you.